So, like the way the Federal Reserve is involved in inflation is, like we said, they're trying to kind of walk this tightrope between unemployment, demand, and inflation. And it has many tools that it can do this, but messing with interest rates is the big one. So the federal funds rate is the interest rate that banks can charge other banks for lending cash. So as required by U.S. law, the U.S. banks have to keep a certain amount of cash in reserve in a Federal Reserve bank to ensure the deposits. So there isn't like a run on the banks like we saw during the Great Depression. And any amount that is over that threshold can be lent out to other banks and like who may be at risk of falling under the threshold. And the interest rate that they charge is the federal funds rate. The interest rate is not set by law, and banks can charge whatever they want. And like the number that is always reported in the news that the Fed comes out and says we're raising or cutting rates, that's actually a target that they set, and and they're very effective at guiding the interest rates to like let's say they're setting it to 2%. They're actually very effective at guiding it to 2%. So like when they say they're going to get it there, that actually means they're going to get it there. It's not like Congress where they're like we're going to spend 100 million, and then they end up spending 500,000. Like that number actually means something. That's why people take it seriously.
But does a lot of that have to do with the competitive marketplace?
With the
as far as control?
Yes, yeah.
Well, what I mean by that is like, so PNC Bank can't charge 10% on a loan that Huntington Bank can offer to somebody for 3%, right?
Yeah, that's just the nature of how the market works. Like if somebody comes in and tries to overcharge everybody, you just go to somebody else. And especially when it's a dynamic market, like how many banks can you name off the top of your, like you would be here for hours just naming banks that you know. So like when there's an open dynamic market like that, the price kind of settles, and then along with the Federal Reserve's influence, they can kind of settle it at the effective federal funds rate, which is the aggregate of all of the market participation.
Yeah, I would encourage anybody who is interested in investing. Yahoo Finance puts out, you can just Google search this, or Yahoo probably wouldn't feel very good about me Google searching. You could Yahoo search it as well.
Yeah, right.
The Yahoo Financial Calculator, which will give you the week ahead, the 2 weeks ahead, and public companies that are having earnings, and it will blow your mind how many of them are banks that you've never even heard of.
Mm-hmm. Yeah, and then think about like all the tiny regional banks. Like shout out to Wayne Savings. I used to work there.
There you go.
Yeah.
Former employee.
Yeah.
Well, their Federal Reserve, that's their playbook. That's their main lever they have is those interest rates, right?
Right.
And recently they've the stimulus that's gone on is something that typically, hopefully, only happens in emergency situations. But the interest rates are what they really use to pull the lever. When the economy is struggling, they lower the interest rates so that they can have the ease of business more affordable, so that they encourage businesses to go out there and expand, go get a loan, go hire people, go buy machinery, whatever they're doing. And then if the economy becomes too hot and they're worried about maybe inflation getting a little bit out of hand, one of the things they can do is they can raise those interest rates to cool that economy off.
Right. Yeah, and then they actually have the Federal Reserve discount rate, which they're actually lending money to banks, but that's usually unfavorable compared to like the market rate. So because they want to encourage the intra-bank lending rather than everybody just going to the Federal Reserve for money.
Yeah.
It's so I wanted to talk about like quantitative easing and like what we went through with 2008 and then with COVID, where the Federal Reserve buys like treasury bonds, or they can buy corporate bonds. And I don't think they ended up doing this, but they can actually buy like U.S. equities, which is insane. So like this is a thing a lot of people don't understand, and I didn't really understand. It's very complicated. Like you could spend 4 years researching this stuff and still not fully understand it. But so when they want to go out and buy treasury bonds or whatever, whatever they want to buy, do you know what money they use to do that?
No, go ahead.
They just do it.
They just do it, right?
Yeah, they just do it. That's mind blowing. Like one of the bedrocks of our economy and monetary policy is just like they just do it. Like, that's so crazy to me.
Yeah. Well, it's crazy in the sense that we could argue, and this is where it could get philosophical. What is really the role of government? Because we've seen this, not only government is expanding,
but it's not attached, or it's not directly attached to the government. It's like private. Like it's not supposed to be attached to any branch of government. It's appointed by the president, and I know it's obviously very intertwined with the government, but it's actually not the government.
It's not, but it's essentially, it acts as a wing of the government.
It acts
right?
as if, but it is, yeah, it's not.
So I think to me, that's too much. It's too much of a blurred line right there.
Yeah.
It used to be.
Yeah, for sure. For sure.
I mean, I even look at it seems to me the Federal Reserve is paying more attention to the stock market than what they had in the past. If they had that dual mandate of as much employment, as close to full employment as possible, and stamping out inflation, at least keeping it in check. And now, anytime that we go through a hiccup of the market, they're doing things to try to soften that, volatility. And you and I have talked before. Can't remember where we heard this, but I heard somebody say this. It hit me, and I was like, man, that's a beautiful way of saying that. They said that volatility is actually finding truth. When the market, we're constantly the Federal Reserve is constantly overstepping things on accident. What I mean by that is, if they feel the economy is getting a little bit hot, they can raise interest rates. Well, if they overshoot that, they can force us into a recession, right? So they got to be very careful. And I see that that's the way the market works. Is the market is constantly overshooting and then it's undershooting. It's getting too high and then it's getting too low. But that middle ground is essentially the truth, right? The natural level of where the market should be. And it seems like to me that, and getting back to our ability to no longer deal with any sort of short-term pain, it seems like we're trying to smooth that out rather than just let it take our medicine and let it do its thing.
Yeah. And then, without sort of the to play devil's advocate, a world before like the Federal Reserve or like interventionist fiscal and monetary policy, you would have these crazy like droughts like the Great Depression. And so when we do have like a central authority that can step in, you can kind of ease the pain with something that drastic. I see your point where we may overstep in some case scenarios, but at a point like the Great Depression where we'd have no recourse to step in and help people, I don't know if that's, I mean, because we don't know. We've just been doing this experiment since like post New Deal. Let's say the Federal Reserve's been around for longer than that, but all the like really where the government will step in and kind of soften the blow for everybody, and then like you have like corporate bailouts in 2008. We're kind of running this experiment, and we don't have a large enough sample size to know if like who knows, maybe the Great Depression was peanuts compared to what we're about to see just because of central banking and large federal governments. We don't really know. I don't think the sample size is long enough. I know I got off on my original point there, but
no, you didn't get off. I'm going to sound very hard and callous, and I don't mean to be that way. I'm just concerned. I'm concerned that every time that we try to soften that blow a little bit, we just create a bigger problem down the road. And maybe I'm completely wrong, but I think we're going to extremes when we measure the Great Depression versus what we just went through with COVID. I think they're completely different animals.
A closer example is probably 2008, because that was a real like without the Federal Reserve, like it's pretty clear like we would have been in total and utter, like the whole world would have been in total utter ruin without the Federal Reserve.
The 2008 event was something that was structurally wrong with the interior, right?
Yeah.
There was something structurally wrong with the banking system. COVID was an external force, and we artificially shut down the economy. We chose to do it, right? Mm-hmm. We didn't have to. I mean, I'm not arguing whether it was a good or bad decision, but we shut it down on purpose.
And that's sort of another experiment that we're running. Like we've never done this before, and then we have no example where like we can point to and say like this is what's going to happen. Like we are in uncharted waters right now, where you stopped the biggest machine known to mankind, which is the world economy, and we have no idea what's going to happen. Like I mean, yeah, sort of things that we're seeing inflation, but then we're seeing the S&P 500 reach record levels, and then at the same time you have like this job report that just came out where 1 million jobs were expected to be added, but we only added 266,000, so 26% of what was expected. Like
a lot of that has to do though with, I think, unemployment benefits, as people aren't going back to work because so that same advisor I was talking to was telling me that they had a Chipotle restaurant that was across from their branch of their bank. And when the last round of stimulus checks were issued, Chipotle had to shut down because all their workers quit. Because some of those workers because they got checks for like $5,000 because they had kids, and it was So it added up. So in their mind, that was an amount of money that allowed them to, for a short period of time, not go to work.
Yes. There's it's some people are not income maximizers, they're income satisfiers. So they'll work up until a certain income threshold. And there's nothing wrong with that. People have different preferences, and
Sure,
we should allow that. Like, we should encourage different preferences. But I mean, yeah, that is one of the, when you do something like this, that is going to hit. If you give people enough money, a certain amount of people are going to be priced out because their income needs are met. So
yeah,
it's pretty crazy.
So the unemployment rate, in my mind, there's a little bit of fuzziness to this because I don't think we're actually getting the true source. When I talk to business owners who are clients of ours, they all say the same thing. I can't find employees. I'll put an advertisement out or a job offering out, and I'll get one or two people that show up, and they're showing up because they want to satisfy the unemployment benefits. Now, I'm of course broad brushing this. There's a lot of people out there that are probably looking for jobs that maybe are having a hard time finding that. But I know just from talking to some of the business owners that there are a lot of the jobs out there, maybe jobs that people don't want to do. And part of that, I think, is if they're getting a paycheck for sitting at home, there's not a lot of incentive to go to work.
Yeah, and then you see, I can't think of any specific examples off the top of my head, but some people are repealing the sort of unemployment benefits just so they can kind of help out. Because, I mean, along with this shortage in unemployment, we're also seeing a shortage of goods. Like, I read every day, like, I read one today, it was like cereal. There's like a cereal shortage. It's like, at the end of the day, like, people actually have to make stuff. Like, you can't just print. You can't, I mean, that concept of like a zombie economy where the only thing keeping it going is government stimulus. It's like, if you stimulate the economy to the point where everybody's needs are taken care of by printing money, then, and nobody works, it's like, the stuff actually has to get made, or like, what are you going to buy? It's like, cool, you make the equivalent of $100,000 a year, but it's like, what are you going to buy if the stuff doesn't actually get made? You know?
Right. And we've discussed the chip shortage is a big thing right now for a lot of automakers or anything in technology. The chip shortage is a big problem right now.
And then that's like, that even goes to like the global supply chain being screwed up because of COVID. Like, that's we could probably do a whole podcast on that, where it's like, it's a lot of different issues coming together. And I mean, it's a big deal. The chip shortage is pretty catastrophic for a lot of industries. Like, I mean, we saw like Ford and GM like closing plants because they just can't make cars because everything nowadays needs these chips.
Yeah, I mean, the cars nowadays are basically a mobile computer.
Yeah.
Yeah.
I don't know if you've experienced the same thing where like, you'll go to get your car fixed and then they like plug something into it. I'm not a mechanic, but they'll plug
it's a diagnostic box.
This is what's wrong, and then they just know.
Yeah,
it's a computer on wheels. Yeah.
Yeah, the mechanics will tell you that it doesn't always give you exactly what's wrong, but it points you in a direction where it says, okay, it could be something related to this, and then you have to dig a little bit deeper. But
what if when we merge with the AI overlords, we'll have something like that where it'll be like a suppository. It'll be like, this is what's wrong with you. Yeah.
Drink more water.
Yeah. Right. Drink water, stretch, exercise, and then you're good to go.